This is the second break-even point video where I attempt to see what the break-even point and illustrate in a moving spreadsheet what this is. Take a look at the first video because I think that one I go a little bit slower, but we're going to try and break this one a little bit faster and just so we can reinforce the concepts here. So again, I'm going to create this little form up here so we can track the economic vacancy, which is the inverse of the vacancy, and then the loss to lease, concessions, bad debt, basically the deadbeat category. So right now, the first year that we have in this deal is we're going to run it at 10% occupancy and 6% concessions, loss to lease. So economic occupancy is 84%, or economic vacancy is 16%, however you guys want to look at it. But yeah, maybe as we move along, just be looking out for this. So again, the income comes in, you pay your expenses, and we're just spotting the expenses on this one, a very healthy 58%. A lot of you guys are familiar with the 50% rule. That's higher than that. And once you pay your expenses, you've got your net operating income here for the first year. The first year is always the worst. Then you pay your debt service, you pay the bank, right? So here's the profit after debt service right here. So we're going to play around with these numbers, and so we can drop this as close to 0 as possible. So we're going to bump this up to 15%, and that gets us to 79% occupancy. There's still room to go, so let's go to 18%, 19. So it looks like 18% vacancy, which is 76% economic occupancy, is right where we want to be. Now what we have to do is, I forgot to drop this down to 0 for assuming we're trying to simulate a bad economy, right? Where rents are not moving up, not moving down. They're just going to stay the same. Vacancy is at 18%, 6%, or economic vacancy at 76%. We lost about a quarter of the tenants here, and therefore we need to tighten the belt because things are getting tough here. Just if you had lost your job, you tighten the belt here. So we're going to do the same things. Taxes, insurance, we've got to pay that, unfortunately. But we're going to try and tighten the belt up on the water and sewer there. General repairs, we're probably just going to start to fix stuff that just we need to. We're going to keep the payroll. We're not going to cut folks, even though that is usually the first thing that businesses will do, is start to cut that stuff. So maybe we cut, I don't know, we'll cut one person's hours partially. So maybe I'll drop it by 10% on just this one. So with that, we cut off about $112,000 of fat per year. And so let's go and play around with the vacancy a little bit more, see how low we can get that. 23%, so about 24. So 24 plus 6 is 30% economic vacancy, which creates the 70% economic occupancy as what I think is the real case scenario, what the break even on this would be. I'm going to peek over, and so here are how the reserve numbers look. Again, the repairs and exterior repairs, a lot of this is going to be put into escrow with the bank. We can't really have access to it. We can possibly get access to it. We could do a business plan change. I've done that before. It's a pain. You've got to work with the bank, and at that point, as occupancy drops, you're really not going to have too much flexibility. The bank's going to want you to go more towards an exit at that point. It's there, but in this kind of situation, I consider off the table. But what we do have to our reserves are about $450,000 of total reserves. So I'm going to remember that number, keep that in the back of your head, and let's go back to the model. All right, we're back to the model here. So what I'm looking at, let's just drop this down another 20%. So let's go to 48% vacancy. So we're a tad under half. We're less than half filled up, which is just, man, if that happens, that's just not going to happen. But at that point, we are losing we're burning through our reserves in a year. So we could run at this at 12 months, and at that point, we would burn through our reserves, and at that point, we'd probably need a capital call. But if things are really that bad, we'd probably have sold at that point because it just wasn't worth it. A lot of these properties that we buy, they're stabilized, cash flowing day one. Of course, there's always that first couple quarters or restabilization period. And that's why you're seeing in the instability in the first year, the first year has the worst net operating income, debt service coverage ratio, because that's really the time where the numbers look the worst. If we can get out of that first initiation stage and get moving, now say something happened in year 2, year 3, we are so much better than we're in this scenario where you're the most vulnerable in that first year. But for just stress testing it and you want to see the highest break-even point, it's going to be in that first year. But again, hopefully that kind of shows how resilient these deals are and exactly why we invest in real estate, which retains its equity, it preserves your guys' investor capital, and that's why we invest for cash flow.